my name is Josh Bechtold. I'm with the CFA Society of Pittsburgh, and today I'm going to be talking about money instruments in banking. So first I want to start off with a few surprising facts about US consumers. First of all, there's only $7,000 in the median savings account balance in the United States. Now with checking accounts, the median balance is only $3,400. This might sound pretty normal for $3,400, but what's surprising is the $7,000 in the savings account. That is actually pretty low. Now, you might be surprised, but 7% of Americans do not have a bank account. For some reasons, people kind of don't trust the banks. They would rather have money in their own hands, but some can't afford a bank account. Now, the average US consumer uses a debit card almost 23 times a month, basically almost once a day. And 71% of banking customers utilize some sort of online banking, whether it be via a laptop, computer, or a mobile app. Now, which accounts am I going to be talking about during this presentation? So what type of money instruments should you have at the bank? I'm going to be talking about 4: checking accounts, saving accounts, certificates of deposit, and money market accounts. Now, before we continue, I just want to stress that you don't have to have each type of these accounts or every type of account that a bank offers. Your banking instruments depend on a lot of factors in your life. Now, first I'm going to start off with checking accounts. Now, I like to start off with a little quote. It says, "The ocean is like a checking account, where everybody likes to withdraw, but no one makes a deposit." Now, what is a checking account specifically used for? These allow you to easily deposit and withdraw money for daily transactions. So anything that you're thinking, if you want to go out and get ice cream, if you're paying for groceries, you would use a checking account with your debit card. And one of the most liquid bank accounts is the checking account. You're able to make unlimited deposits or withdrawals from those accounts, basically because you're going to be having this daily transaction. Now, most checking accounts may have daily maximums ranging from $300 to $5,000 for what you're able to withdraw. So what is the purpose of the account? So it's primarily for holding money in the short term. Obviously, like I said, for daily transactions, you're able to make unlimited withdrawals and deposits, so it's not meant for any type of long-term investment. These interest rates that you receive on checking accounts are very, very low, ranging from basically 0.001% to 0.1%. So you will basically be getting nothing in return for your money, which is why that this is a very short-term type of account. So one of the more popular aspects of a checking account is the ability for direct deposit. This automatically sends your paycheck to your checking account or a portion of your paycheck. You can also move a portion of your paycheck into a savings account or any other type of account. So here are some fees that you should be aware of. One of the most infamous type of fees from this account are overdraft fees. This is whenever you spend more money than what you have in your account, and you can be charged up to $30. Now, the best way to avoid this is by ensuring overdraft protection, which a lot of banks offer. You can also decline the transactions or take funds from savings accounts or any type of accounts that you have at the bank. Now, service fees is another one. This is a lot more common. It's usually a monthly rate of fee that can change and be anywhere up to $15. So there's a certain balance that you have to maintain to avoid this, as well as you can find no-fee checking accounts, which are a little bit less common, but they're still out there. So now you're probably asking yourself, how do I open a checking account? Well, it's actually really easy. You can sign up online or visit a local branch of any bank of your choosing and provide your personal information. Now, some banks may run a soft pull for your credit score. Now, I say soft pull because anytime that banks pull your credit score, they don't want your credit score to be affected, so they do a soft pull, whereas if other companies or other organizations need to pull your credit score, this would have a negative effect on your credit score, actually lowering it. Now, you might require a deposit between $1 or $50 to open an account. A lot of banks require some type of minimum amount. This is usually going to be it, nothing too much. Now, most of these accounts are verified and FDIC insured, which means that up to $250,000 in that account is saved. Next, we're going to be talking about savings accounts. So what is a saving account? This is a basic account for depositing money with the intention of keeping it safe and earning some interest. So savings accounts earn more interest than checking accounts, although not that much, usually anywhere between 0.5% to a couple percent if you're lucky, depending on interest rates. And these can be used to set aside funds for long-term goals, investing, retirement, owning a home, anything like that. Now, here are some benefits for savings accounts. They are held safely at your bank. These are also FDIC insured, up to $250,000, similar to the checking accounts. And it prevents you from any unwanted spending. So if you put money in a savings account, you're more inclined to save it than if you put it in a checking account. Now, growth and interest is an important factor in savings accounts. These accounts pay interest on money in your accounts. They are usually very low, like I said, between 0.5% and a couple percent, depending on interest rates. And the risk of loss is virtually non-existent because, like I said, FDIC insured up to $250,000. And it's an interest that kind of combats inflation, which is pretty important. So now you're probably going to ask yourself, how do I open one? Well, you would want to compare banks by interest rates, fees, minimum balances, and other things like that. It's pretty easy to go online and search for one of the best savings accounts that you can find. And you want to focus on convenience, whether by location of the bank or mobile app navigation. Like I said, a lot of people nowadays are using online banking, so you want to find a bank with a very smooth-looking website and a great feel to it. Now, interest rates only matter if you're depositing large sums of money. So you'd have to gather personal info for your account and then make the first deposit. Now I'm going to transition to money market accounts. So money market accounts are an alternative form of savings accounts. They pay interest on deposits and limit how often certain transfers can be made. They typically earn more interest than savings accounts or checking accounts with your money, and they're easier to access and spend funds. So they are similar to checking and savings accounts as they are FDIC insured up to $250,000. So here are a few things that money market accounts can do that savings cannot. First of all, they can provide check writing and debit card privileges. You can open up a debit card with your money market account, and you can also write checks with it. You can also invest in securities like certificates of deposit, government securities, and commercial paper. Interest rates vary more with inflation. So here are some disadvantages of money market accounts. Federal regulations limit 6 transactions or electronic payments a month. Certain sums of money are required to open an account. This is usually a higher limit than savings accounts or checking accounts. It's required to keep the account balance at a certain level, and then fees are imposed otherwise. And lastly, interest rates are still relatively low compared to other securities like equities or bonds. Finally, I'm going to talk about certificates of deposits. So these are another form of savings accounts. They are interest-bearing accounts like the rest. You're also FDIC insured up to $250,000. They are considered one of the safest saving options. They're issued by the bank or a brokerage firm. So what makes it different? First of all, it holds a fixed amount of money for a fixed period of time. For example, you can open a $2,500 CD for 12 months at 2%. This means that for the next 12 months, those $2,500 are going to be earning 2%, and if you take the money out early, you will get a penalty. Now, interest can be varied, they can be variable or fixed, paid monthly or semi-annually. So, how to choose? Every individual is different in their needs and their financial goals, so you might not need each and every account. So look at what accounts you might have and ask yourself if you can find an option that aligns more with your goals. Your bank accounts should reflect your financial goals in life. Thank you, and if you have any questions, please feel free to reach out to us at the cfasociety.org/Pittsburgh. Thank you.